Becoming a millionaire is simpler than you think, and it doesn't take lottery luck, crypto gambles, or burnout. Hi friends, welcome back. I'm Diane. I've spent the last 15 years in finance and consulting, from the World Bank to private equity, seeing how real wealth is actually built. And here's what I found. Most millionaires aren't trust fund kids or stock picking geniuses. Nearly 8 out of 10 built their wealth over time by running a simple system, setting it, sticking to it, and letting time do the heavy lifting. So in this video, I'll show you 3 things. First, the millionaire math so you can pick your number and your timeline. Second, the boring but brilliant strategy that quietly beats most pros. And third, a catch-up playbook if you're starting later than you'd like. So grab your coffee and let's dive in. So let's start with the math. Compounding is your money earning returns, and then those returns earning more returns. Over very long periods, the US stock market has delivered about 10% per year before inflation, or around 6 to 7% after inflation. So to keep it conservative, let's use 7%. And here's what it would take to reach $1 million by 65. If you start around 25, you'll need about $380 per month invested. Start at 30, $550. Start at 35, over $820. At 40, over $1,200. At 45, over $1,900, and at 50, over $3,100 per month. So you can see the earlier you start, the more the market does the heavy lifting. If you wait until later, it's still possible, but you just have to lean harder on contributions and income. Think of it this way. Starting at 25 is like skipping out one dinner out once a week. Starting at 40, that's like a second car payment every month. Same million, very different paths. But let's pause here for a second. $1 million today isn't the same as $1 million in 30 years. Adjusted for inflation, it may feel closer to $500,000. That's why you need to think in terms of your freedom number, what it takes for you to live a work optional life, not just an arbitrary milestone. And if you're curious about your freedom number, timeline, and what work optional could look like for you, I built a free tool called the Personal Rich Score Quiz. It gives you a snapshot of where you are in your next 2 moves. So link is in the description box below. And here's what's powerful. 79% of millionaires didn't inherit their money. They built it slowly and predictably. If they can, so can you. So a quick question for you. If you had to pick one lever today, cut expenses, grow income, or extend your timeline, which one would you do? Drop it in the comment box below. So now the math is done, let's talk about strategy. Most people don't miss their goals because they're not smart. They miss them because they chase hot tips, start and stop, or bleed out on high fees. The winners, they run boring, rule-based systems. So here's a basic formula. You want to use a low-cost, broad index fund as your engine, total market or S&P 500. You can consider a bond sleeve as you get closer to needing that money. Next is to automate contributions and set a small auto increase each year. Additionally, you'll want to capture match. Your employer match may often add 3 to 5% of pay. In some places, I know that they add 6%. Don't leave that on the table. It's basically free money. Next is try to keep fees small. On $250,000 left alone for 30 years at 7%, a 0.05% fee grows to about $1.8 million. At 1%, it's only $1.4 million. About $440,000 gone to fees without any extra risk. Also be tax aware. Keep interest-heavy assets in retirement accounts. Broad stock funds are tax efficient in taxable accounts. So consider the 401k, the 403b, the TSP IRAs, the Roth IRAs, and if eligible, HSA can double as long-term medical savings. This is a while back, but back in 2013, even Warren Buffett told his family trustees 90% in a low-cost S&P 500 index, 10% in short-term government bonds. Why? Because it's simple, cheap, and boring works. Here's the bottom line. You don't need to be the next Wolf of Wall Street. In fact, please don't. The boring system already beats most pros. If boring investing makes you yawn, good. Boring also means you're sleeping well at night. Try doing that while day trading crypto at 3 a.m. Now, if you're in your 40s and 50s and thinking, I'm behind, you're not too late. You just need to pull 3 levers even harder. First, contributions. Second, income. And 3 is time. First is contributions. Attack the big 3. On average, US households spend about 33% on housing, 17% on transportation, and 13% on food. That's over 60% of your budget. These categories are where you could potentially win. So if you think about downsizing or house hacking, keeping a paid off car, shopping for insurance, and meal planning a little bit more, you can free up anywhere between $300 to $800 per month. Take that money and redirect it into investing. So if you invested $600 for 20 years at 7%, you'd have over $300,000. Now, if you've got debt, especially high interest credit cards, there's no amount of investment greater than paying off that debt. So be in the position to pay it off as soon as possible. The second is income. And this is really, I find, an underrated superpower. A 10,000 raise invested every year for 20 years at 7% would grow to about 400,000. That's nearly $500,000 from one pay bump. But millionaires don't just stop at a raise. The IRS reports that the average millionaire has around 7 income streams, from salary to dividends, rental income, business income, capital gains, royalties, and more. And while you don't need 7 side hustles, unless you enjoy being chronically busy, that said, having just 2 or 3 solid income streams, like your day job, a small side offer, or investments, can dramatically accelerate your path to freedom. And here's why that matters. The US added over 300,000 new millionaires in 2024. That's over 1,000 new millionaires every single day, bringing the total to nearly 24 million Americans with million-level net worth. So when you think about income, just don't rely on your job. Start layering in streams that can grow even when you're not working. I think this point is so important, and I learned it the hard way. A quick personal story here. After I got my MBA, I landed a $200K job, and on paper it looked great, but behind the scenes, toxic environment, constant pressure, and high anxiety. And then I was let go within 17 minutes notice. No time to say goodbye or anything. All I could think about at that time was my 1-year-old daughter in our apartment. That moment basically changed everything for me. And I knew I never wanted to be in that situation again, for one person or one job to have that much control and leverage over my life. So that's why I started to diversify and build multiple income streams. I started to invest more, looked into dividend investments, REITs, and made money online and additional consulting. Today I've explored over 6 income streams, and my advice is to have an emergency fund, 3 to 6 months minimum, 6 to 12 if you have a family, or 12 plus months if you're on more the conservative side. There are inevitables in life, and it's better to be prepared than not. So consider multiple income streams, like investing in businesses. This is how you make more. And here's what I thought was a little bit funny. 1 income stream is called stress. 2 or 3, that starts to feel more like freedom. Now, working a few extra years is one of the most powerful financial moves you can make. Each additional year you work gives your investments another year to compound, adds another year of contributions to your retirement accounts, and reduces the number of years your savings need to last. It also allows you to delay tapping into retirement accounts. And just working an extra 2 to 3 years can actually increase your retirement account by nearly 20 to 30%. And it's not about working forever. It's about strategic timing. And speaking of timing, this is where Social Security also comes in. As of July 2025, the average retired worker receives about $2,000 a month. And across all beneficiaries, the average check is about $1,800 a month. Nearly 9 in 10 Americans 65 plus collect benefits. For about half of retirees, it makes up at least 50% of their income. For 1 in 4, it's about 90% or more. But Social Security was designed to replace only about 40% of pre-retirement income. And the trust fund is projected to be depleted by 2033, leading to a possible 23% benefit cut unless Congress acts. So timing matters here. Claiming at 22 locks in reduced checks for life. Wait until 70, you're basically boosting your benefits by about 77% compared to 62. Think of it as giving your snowball 2 extra pushes downhill. It rolls farther, faster, and gives you options. Here's a quick reality check. Day trading won't save you. 97% of traders lose money long term. But trimming $600 from expenses, securing a raise, and delaying Social Security can add hundreds of thousands to your retirement. And here is a math example illustrating how trimming expenses, securing a raise, and delaying Social Security can add hundreds of thousands. So if you trimmed $600 a month, multiplied by a year, you'd have over $7,200 per year. That invested at 20 years at 7% is close to $300,000. Now, if you secured a raise for $10,000 a year, invested it for 20 years at 7%, that's another $400,000. And if you delayed Social Security benefits, instead of claiming at 62, you claimed it at 70, basically that's a 77% increase in monthly benefits. And that would yield potentially another $300,000 in additional benefits. Now, if you worked a little bit longer and delayed retirement, you'd basically have another $1 million in retirement. So this demonstrates demonstrates how these strategies combined can indeed add hundreds of thousands of dollars to your retirement. So the catch-up plan isn't flashy, but it's powerful. First is contributions, basically free cash from the big three. Second is income, negotiate smarter, monetize your skills. Third is time, extend your runway. That's how you go from behind to back on track. Now, if you're listening and you're thinking, I need a plan that fits my family and my timeline, this is exactly what I help people do. You can book a free clarity call where we'll map out your freedom number and work optional runway. So link is in the description box below. So here's your plan. Pick your number, whether it's $1 million or your personal freedom number. Automate contributions and bump them quarterly. Trim the big three and redirect the savings, and add one extra move this quarter. Keep it simple, low cost, and rules based. Imagine logging in at 65 and seeing 7 figures, not because you gambled, but because you stuck to a calm, boring, and totally doable system. You don't need lottery luck or a 100-hour work week. You need a simple system, patience, and a start. Future you will be very happy you did this. Friends, if you made it this far, thanks so much for watching. You can check out my next video over here. See you in the next one.